Our companies are investing aggressively now because they see enormous opportunities, whether it's in the genomics space, the robotics space, energy storage, artificial intelligence, blockchain technology. So we have, I think, one of the most massive misallocations of capital in the history of mankind. You have investors investing in the past.
Cathie Wood's ARK Invest and her firm's innovation-based investment style has been smashed relentlessly for over a year now. ARK Invest's flagship Innovation ETF has fallen from over $150 at its peak in early 2021 to now under $65 with no signs of respite for investors. With headline after headline reporting on out-of-control inflation, global political tensions, and increased regulation feeding the collapse further, the one question on every growth investor's mind is when will it bottom out? In her latest interview, Cathie Wood speaks on how the price collapse in the 5 main areas of innovation, genomics, robotics, energy storage, artificial intelligence, and blockchain technology is the largest misallocation of capital she has ever observed, which is offering investors the greatest opportunity of all time. Make sure to stick around to the end of the video where I will cover some of the latest on-chain Bitcoin and Ethereum data to see if it backs up Cathie's investment thesis. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
All we do is focus on innovation. The biggest surprise to us in the last 3 years is the amazing set of breakthroughs in artificial intelligence. We've got AI costs. We've got AI moving more than twice as fast as Moore's Law. Costs dropping 60% per year if you account for both the hardware and the software. When you get the cost of something dropping that much and to levels that are much more accessible and affordable, you're going to have an explosion in creativity. And that's what's happening. What has happened to our world, our traditional financial world, is intense risk aversion caused by, first, the tech and telecom bust in the early 2000s, and then even more so after 08, 09. And what does risk aversion mean in the traditional world? Risk aversion means get close to your benchmark sensitivity. So we have, I think, one of the most massive misallocations of capital in the history of mankind. You have investors investing in the past. Benchmarks are where they are, and especially the largest companies and stocks in the benchmarks are where they are because of past successes. If we're right, those are the companies that are going to be disrupted. And you can see, if you look at large cap growth portfolios or large cap any portfolios practically, you'll see many of the same stocks, but in growth, you'll see the FANGs, you'll see Microsoft, you'll see NVIDIA, you'll see Tesla, because it was put in the benchmark finally. The only one we overlap with is Tesla.
Why such a reticence, though, to concede that some of these stocks that have suffered dramatic declines will never come back to the level at which they once were? You won't concede that? You think all of these stocks that I read on that list, plus others that are down by significant amounts as well, are really going to come back to the prior levels they were?
Absolutely, and beyond. You'll notice what we do during risk-off periods, and this one has been particularly long, 1 year, which has taken our stocks into bargain basement pricing, I'll say again. But the names you read have migrated into our top 10 because we have concentrated our holdings towards our highest conviction names. And most of the names you read are in our top 10. I think many of them are platform companies. Many of them are going to harness artificial intelligence in a way that others cannot. I mean, Tesla has been the best case in point, and I think we have a lot of Tesla-like stocks in our portfolio. We're really looking for companies that are going to use artificial intelligence and create competitive advantages that no one will be able to catch.
I agree with you about the pendulum having swung very far. I don't know if it's all the way yet. It's hard to without the benefit of hindsight. But every time I want to pull the trigger, and buy your flagship fund, ARKK, two things stop me. And maybe you can talk me and other people who are watching out of these two problems that I have. The first is not in your control, and that is the inflationary environment and what's going on with rates. If this is your strategy and you're going to stick to it, unfortunately, you're up against a headwind that is not of your making, and really there's not much that you can do about until it abates, which is that historically, go back through the last 100 years, break it down in decades. Decades with high inflation were very bad for growth stocks relative to value stocks. Just look at the 2 decades with the highest inflation, the 1940s coming out of the war and the 1970s. In those 2 periods, using FAMA French indexes, value outperformed growth on an average annualized basis by more than 10%. That is an insurmountable hurdle to anybody concentrating in growth stocks if, in fact, high inflation is going to persist. Again, that's not your problem, but I'd love to hear your take on that. The second thing is a little bit more idiosyncratic to ARK and the way that you guys do portfolio construction, which is that there tend to be a lot of glamour stocks in your index and in your products that maybe aren't that innovative. And a couple of examples that come to mind, I was kicking the tires on your Genomics fund. I can't get past the fact that Teladoc is the largest holding. In what way, shape, or form is Teladoc at all involved in genomics? DraftKings, Robinhood, these are not really innovative companies. One is a bookie, and one is a fairly traditional broker that made its way by breaking a lot of brokerage rules. I don't see innovation there when I see those names, and that's why I'm not an investor as badly as I want to be. Can you talk me out of those concerns that I have? Because I think they're shared by a lot of the people watching today.
Sure. Absolutely. And Josh, I heard that you had some kind words to say about us as a firm or generally. So I thank you for those a few weeks ago.
I think very highly of you.
Thank you, Josh. So on the first, inflation. Okay, my background is economics, both economics and finance, and I do have a point of view here. The supply chain issues have lasted so much longer than we anticipated that they would take a while to work out, but not 2 years. So the question is this supply chain related, and will these inflation metrics unwind? I think a lot of what's going on is supply chain related. I know it's become unfashionable to use the word transitory, and so we won't, because it's lasted longer than we expected. However, I do think there's going to that the deflationary forces that are building up in the economy today are pretty strong. 2 are secular, 1 is cyclical, and the bond market is sort of getting this. If you look at what's happened to the yield curve, so the difference between long rates and short rates, it has flattened from, I think, 155 basis points last March to 45 basis points today. And if the Fed did go 50 basis points in March, which they might, I think that it would be one and done then, we'll end up with an inverted yield curve. And then what are people going to think? Well, an inverted yield curve and the flattening yield curve says, watch out. Something's going on here. Either growth is going to disappoint or inflation is going to be much lower than expected, or both. And we think both is right. And so that's the cyclical source. There's an inventory buildup. If you look at the record-breaking inventory buildup in the fourth quarter GDP report, you'll get a sense, while inventory to sales ratios might be low, as the consumer switches off here. And if you look at the last 3 months of either retail sales or consumption, the consumer has gone pretty flat. Meanwhile, you've got the double ordering and triple ordering by manufacturers and wholesalers because they were missing sales before. So I think there's a big inventory problem brewing here. And it's going to hit within the next 6 months in terms of that recognition. That's the cyclical side of inflation. The secular side has to do with innovation. So our focus is understanding cost declines associated with technology, and when costs are going to drop low enough so that demand in different sectors will pick up. Just give you a few examples. So for every cumulative doubling in the number of whole human genome sequenced in the world today, costs drop. The cost of sequencing drops 40% if you're Illumina, 28% if you're a PacBio on the long read side. Robotics, for every cumulative doubling in industrial robots, cost decline 50%. We have major labor shortages. So that cost decline will cause increased adoption and will lower the risk associated with wage inflation continuing. And then artificial intelligence costs, I gave that one, down 60% per year if you include both hardware and software. These are major deflationary undercurrents. The other side of disruptive innovation is creative destruction. And what does that mean? It means the existing world order, the traditional world order, is going to face disintermediation and perhaps destruction. And we certainly see this in everything: transportation, in retail. There's still a lot of creative destruction taking place.
Right.
In the healthcare space, right? So what's going to happen is these companies whose products are either going obsolete or who have not invested enough to update them, they are going to have to cut prices. So we see major deflationary forces, and I think the bond market is on to this. If I didn't see some signal supporting what we're saying in the marketplace, like that yield curve, I'd probably say, gosh, I don't know how long this is going to last. But I have a feeling these deflationary forces have entered the bond market cycle.
The criticism is rife right now. Your stock picking prowess, as I said, your research, which you are defending multiple times here. I'm wondering what you make of the criticism, whether you think it's gotten too personal, the fact that there is literally now an ETF betting against you. What do you make of that?
Well, I find that very interesting, especially the last. When you think about it, it's simply a call. Well, they're shorting innovation, and that seems to me over time that's not going to be a business. If you ask me, consider the source. But they're also not doing any research. They're simply shorting innovation. If they were doing research and could point us to reasons why what we have included in our portfolio is not going to participate in the new world order, then we might have a conversation about it. But the idea of shorting innovation in America is ridiculous, I think. But here's what I do know. When I see, and this is investor psychology, when I see people so sure that we are wrong, and that they are willing to set up companies simply to short innovation, and to set up funds to short innovation, you know that investor psychology, the pendulum, has swung so far in one direction that if we're right, then the rewards are going to be enormous.
I don't know how else to say it. They're not shorting innovation, they're shorting you.
Well, we stand for innovation. If it's an interesting, another interesting idea that surfaces as you say that. I, again, was in the bubble, but I was in the markets in the 80s and 90s. And where did investors go to access exposure to innovation? They went to the NASDAQ. I'm looking, and we're benchmark agnostic. Our goal is to deliver a minimum of 15% compound annual rate of return over a 5-year period. So we're benchmark agnostic, and until recently, I just didn't know how the NASDAQ had evolved. So if I look at the NASDAQ 100, what do I see? I'm shocked to see in there, if you look at the overlap with our portfolios, and not just the flagship, I'm talking about all of our portfolios, the specialized ones, only 25% in the NASDAQ 100. The top 50% are the FANGs, Tesla, NVIDIA, Microsoft, roughly. That's very rough. And that's why you see so many top 10 portfolios, top 10 stocks in portfolios out there to be those. And then if you look at further, you see food stocks. Like, this is not the NASDAQ I grew up with. You see like Kraft Heinz or Pepsi. You see Old Dominion and trucking. You see CSX and rail. You see Dollar Tree and other dollar stores. You see a lot of bricks and mortar retail. And now it's that ilk of stock is roughly 10%. So what's left is what we would call either companies going to be disrupted by innovation, or they're involved in sustained innovation. So this is not the true innovation index anymore.
So there's Cathie Wood with as high a conviction I have ever seen from her. She's extremely confident in her investment strategy and believes that this current collapse in price is the greatest opportunity of all time for investors. Do you think she's got it correct? Let me know in the comments. One point of view that I think does really help Cathie's investment style is the unstoppable march and exponential growth of technology over time. Not only does betting against technology seem futile, but on a long enough timeline, it does prove to be very costly as well. Will this time be any different? We'll have to wait to find out. Now, looking at some on-chain Bitcoin data to see if it backs up Cathie's thesis, first out from on-chain analyst Will Clement, we have an update on Bitcoin whales. As you can see, whales in the last month or so have moved out of distribution and back into accumulation, the first instance we have seen since September of last year. This does back up Cathie Wood's research that capital inflows are coming back into risk-off assets. Another bullish chart, but this time for Ethereum, is the total Ethereum balance on all exchanges, which is just continuing its downward trend despite price action. Despite the sell-off, investors are using Ethereum more and more and taking it off of exchanges for usage and long-term storage. If there is one comforting chart in all of crypto, I would say it would be this one. Once demand returns, there will be no supply left to satisfy it, pushing prices in only one direction. Anyway guys, hope you enjoyed today's video and that provided you with some value. I'll see you all in the next one, and as always, have a great day.